Hey guys, Dave Keller here with Market Misbehavior. We like to occasionally do what we call a choose your own adventure style video. We take the S&P 500, we lay out 4 potential scenarios. You vote on which you see as the most likely and why. So today, it's all about what's next for the S&P 500. So 2022 certainly was a challenging year for risk assets. The S&P, the NASDAQ having a consistent downtrend into the lows in October. But mid-October to mid-January of 2023, we've had a nice reversal to the upside. A lot of stocks following through to the upside here in the new year, but the major averages really yet to break out, even though a lot of individual stocks are doing so. Today we'll look at a chart of the S&P 500, break down some of the key levels, and describe 4 different potential scenarios for the S&P 500. Before we get there, if you like this sort of thinking about investor decision-making, technical analysis, behavioral finance, market history is of interest, I hope you'll subscribe to our channel. Also, give the video a like if you appreciate it. We very much appreciate that back. Finally, don't forget to put a comment below. Which of these 4 scenarios do you see as the most likely and why? Now, when we look at a chart of the S&P 500, my chart of the daily chart of the S&P is pretty busy, so I'll just orient you to what all we're seeing here. Daily open, high, low, close. The blue line is the 50-day moving average. The red line is the 200-day moving average. So it's going to come. We're going to come back to that, but let's note the fact that here as we finish this week on January 13th, we closed above the 200-day moving average for just the second time since April of this year. April of last year. You also know we're just below this trend line, which is the green dashed line. So this is a trend line connecting the highs in January of 22, March of 22, August of 22, November, December of 22, all line up almost perfectly. That's just above current levels. By the way, we're right at that key big round number of 4,000, which certainly could be meaningful as well. Now, 4,000 is an interesting level because if you take the August high to the October low, you go 38.2% of the way up. That's 3810 or so. That's right around this purple horizontal line. 50% just above 3,900. 4,000 is a 61.8% of the way back up to the August high. So the fact that we've sort of stalled out there in November, December, and now hitting there once again, probably pretty important. So we have what's called a confluence of resistance, a number of different techniques, Fibonacci retracements, traditional support and resistance levels, trendline analysis, and moving averages all agreeing that this 4,000 to 4,100 level is pretty meaningful. That's why we have it as a blue shaded area on this chart. It's sort of what we call a pivot point or a magnet price, a level which is so meaningful by a number of different disciplines. If and when the price gets there, you expect at the very least some consolidation, certainly some recognition from the market of the value of that resistance level. Now, when we think about what's next, right, think about what's actually happened with the S&P in the second half of the year. I was talking with Tom Boley from Earnings Beats earlier this week, and one of the things he and I were talking about was, you look at the chart of the S&P 500, key in on that May low, right? The May 2022 low was just above 3,800. It was almost to the penny at key Fibonacci levels. Take the last 3 years, go back to the March 2020 low to the January 2022 high. 38.2% of the way down is just right around that level, just around 38.15, 38.20. That's also a 61.8% of the way back down to the September-October 2020 swing lows there. So Fibonacci analysis, and we've done some videos on our channel here talking about that larger structure from the markets using Fibonacci retracements. All talking about just above 3,800 as a key level. So not surprising we're finding support there in the last couple weeks, but certainly meaningful that we bounced off that level in May. From there, you can see that the market, while it's chopped around quite some bit, really hasn't gone anywhere, right? Right now, we're around 3,900. Last week, we finished last week around 3,900. That's literally where we were in May of last year. So while we've chopped around quite a bit, and there's been a range from 3,500 on the lower end to 4,300 on the upper end, at the end of the day, we keep pivoting around that 3,800 level. So you could make an argument that the sell-off in the first half of 2022 was to get to 3,800. From there, we've basically been in a bottoming pattern. And a number of times now, we've traded below 3,800. Every time, buyers have certainly come in. So maybe 3,800 is the bottom. And this is just a series of attempts to undercut that level, only to be matched by buyers coming in and pushing the price back to the upside. So let's talk about the 4 potential scenarios. And what I want to do before I get there is highlight a couple key levels that we're going to be paying attention to. It got sort of all my noise off of the chart, and we're just focusing on some big key levels here. 4,300 to 4,320 is basically the high from August of this year. Of last year, right? That rally into the August peak was when we hit the 200-day moving average and pulled back. If you remember, the sentiment was super positive here. This is when everyone's getting all bulled up. We broke above the June high, and I know a lot of people were thinking, are we retesting 4,800? Is 5,000 plus in the cards for the S&P 500? The market turned on a dime, never closed above 4,300 there, maybe just a day or two, and then rotated right back higher. Never got above the 200-day moving average for sure. So if we would rally further, I would argue that that August high is an important pivot point, right? That's a level. If we can get above the 200-day, I think that's the last real key level to pay attention to. 4,100 is certainly a short-term level, absolutely right. But I think that 4,300 level is really, really important if we could get above that point. Now, on the downside, we have this red horizontal line. That's keying in on the May 2022 low. That was when we first hit 3,800 from above after the rally phase in 2020 and 21. We've had a series of attempts to undercut that. And then, of course, we have other levels to pay attention to, like the June low, which really was a significant low as well, and the ultimate low around 3,500 to 3,600. That's where we essentially bottomed out in October. So as you're thinking about a structure of the market, what are the potential scenarios? Well, here's the chart where I would lay out where these things could be. And when I'm thinking of a time frame, I'm really thinking about the next 6 to 8 weeks. So you can see I fast forwarded this chart through basically the end of the first quarter. I'm going through the end of March. So 6 to 8 weeks would take us sort of early mid-March. I'm sort of in this part of the chart. Where do you see us ending after 6 to 8 weeks after today, basically from mid-January to the end of February, early March? The uber bullish scenario would be not only do we break above the 200-day moving average, which we just did today. We'll see if we follow through next week, but so far we've gotten through there. We follow through and break right through this trend line, and for the first time in quite some time, we actually break above trend line resistance. We don't stop at the August highs, but we actually break through it, and that's why this uber bullish segment, section 1, starts above that August high. So basically, this would be the rally phase we've seen beginning in October, really continuing in early January, escalates. We continue to see risk assets going higher. Most likely, rates remain muted because the way that stock prices go higher, and certainly our growth-oriented benchmarks, you'd most likely need to see rates remain relatively low in this scenario. The Fed is wrapping up things very quickly. Maybe we get 25, 50 basis points here in early February, maybe one more hike, and that's it. Inflation comes down. We continue to see encouraging economic data sort of suggesting that the action the Fed has taken so far has really started to take hold. And those early signs we've seen of inflation slowing really materialize and accelerate, right? Earnings season, which we're starting here in the next over the next couple weeks, becomes more encouraging, right? You see companies, instead of being cautious about 2023, are more optimistic and talking about the light at the end of the tunnel, and that inflationary pressures won't be as bad as investors might expect. This uber bullish scenario could certainly mean a retest of the all-time high from January of 2022, around 4,800, or even a move to new all-time highs, which is possible. I don't know if that's a likely scenario, but it's certainly possible that we go to new all-time highs. But the uber bullish scenario would basically mean we finish above 4320, basically above the August 2022 high. The mildly bullish scenario, which is here shaded in blue, means we do all the first part of what I just said. We do get above the 200-day moving average. We break above trendline resistance and kind of stay there, and we probably get above 4,100, but we don't get much further. We don't get above the August highs, and that August level becomes resistance. And I think that's a very possible scenario because if we continue to go higher, if we continue to accelerate, at some point, investors may look at inflation data and may look at economic data, may look at prospects of a recession. And while they're not super bared up and super short and super cautious because of what a recession may mean, they don't see the euphoria that we've seen off the October lows as being sustainable. This is where investors start taking profits on the gains we've had since October. A lot of those sectors like industrials and materials and energy, even consumer, that have had these really good runs, we start to see profit taking in those names. And while they don't go down in a really negative way, they just stop going up as quickly as they have off the October low. So that mildly bullish scenario basically means we sort of fill in some of this range between 4,000 and 4,300. We end somewhere in that area. So we break out, but we really don't just accelerate to the upside like that uber bullish scenario. So that's scenario number 2. Now we get to the bearish scenarios, and scenario number 3 is one of the 2 where we fail to get above this trend line, right? We attempt to get through the trend line, which is maybe what we're starting to see here in the last week or so, but we don't really follow to the upside. We certainly don't get above 4,100. We fall back in, and we sort of back and fill between the June low, which is around 3,650, and that pivot point of around 4,000, right? So we fail to break above the trend line, but we don't really, bomb out these markets. We sort of fill in. And what could happen here is some of the value-oriented stocks, things like industrials and materials, could actually continue to do very, very good. Rates maybe remain elevated in this scenario, and because rates are higher, those growth stocks that were looking to emerge, like Amazon and technology names and maybe communication services, aren't able to really materialize enough gains to push our benchmarks higher, because higher interest rates make the growth prospects a lot less attractive. Earnings season may not be as exciting or maybe as positive as in the bullish scenarios. Maybe companies are a little more cautious, which sort of puts a wet blanket on the rally that we've seen off of the October low. So mildly bearish scenario, sort of continuing this choppy backing and filling period we've seen over the last 6 months for stocks. That brings us to the most bearish scenario, scenario 4, the uber bearish scenario. What happens if we fail to break out above the trendline resistance? We fail at the 200-day, we roll over, but then we accelerate. The Fed starts, continues to raise rates. Interest rates continue to go higher, which means our growth-oriented benchmarks have very little likelihood of materializing upside gains. But not just that, the rally that we've seen off the October lows proves to be way too optimistic. Companies in their earnings reports over the next couple weeks talk about caution, talk about the impact of inflation on their businesses, talk about much lower growth prospects for 2023 and beyond. The recession ends up being much more painful than many probably expect, and the signs of a recession continue to emerge. Inflation, instead of coming down, which we're starting to see, actually remains elevated. We start to see some upticks in inflationary data, suggesting that all the efforts the Fed has done have not even scratched the surface yet. The uber bearish scenario, where we undercut the May 2022 low, undercut the June low, would have to be a very strong reaction to negative economic data, certainly the Fed being way more hawkish than dovish, and a lot of negativity coming from earnings releases, as opposed to some of the optimism that investors have been feeling so far year to date in 2023. So there, folks, are our 4 scenarios. The uber bullish scenario, we finish over 4,300. The mildly bullish scenario, scenario 2, where we end the next 6 to 8 weeks between maybe 4,000 and 4,300. Number 3, the mildly bearish scenario. We don't really follow through much further than we've seen so far off the October lows, but we don't get below the June low around 3,650. The uber bearish scenario 4, is we undercut the June lows, potentially make a new low for the cycle, and conditions continue to get more negative. Which of those 4 scenarios do you see as most likely, and why? Let me know in the comments below. Before you do that, give the video a like if you appreciate it. We'd very much appreciate that back. By the way, this exercise is called probabilistic analysis. Let's think about different scenarios. Position yourself for the one you see as most likely, but plan for the other 3, because all 4 of these are possible. For Market Misbehavior, I'm Dave Keller. Be well, be safe. Talk to you again soon.